Well, good morning, everybody, and welcome to BakeHostetler's webinar, Equity Markets and the COVID-19 Pandemic. I'm former Congressman Mike Ferguson from New Jersey, and I'm the leader of BakeHostetler's federal policy team in Washington, D.C. To all of our attendees, please feel free to submit questions by using the question box on your screen. For those in the media who are on the webinar, if you would like follow-up questions or quotes from any of our participants, we encourage you to follow up with the communication departments with each of their companies and organizations. Joining me today as my co-host for this webinar is Kevin Edgar. Kevin is my colleague at the Federal Policy Group at BakeHostetler. He was the Chief Counsel of the House Financial Services Committee, and prior to serving as Chief Counsel, he managed and led the committee's capital markets, securities, and investment portfolios. Good morning, Kevin.
Good morning, Mike. We have a great lineup this morning. It's good to be with you. And we have three senior executives from the NYSE, Nasdaq, and Cboe Global Markets. And all of them are members of what is known as the Equity Markets Association, or the EMA. And they're going to share with us their views on how the markets have been operating during the pandemic, the SEC's regulatory initiatives as it relates to exchanges, and other public policy issues that come up from time to time when markets experience a little more volatility than normal. So I'm looking forward to a good webinar today.
We do have a great panel of experts with us here today. The United States is slowly reopening as leaders hope that the spread of the COVID-19 is contained and some aspects of life can return to normal. Yet, uncertainty still prevails and the pandemic's economic effects are reverberating across the country. Since the COVID-19 pandemic hit the United States, the U.S. equity and options markets members have demonstrated that our markets are resilient and can handle historic volatility, message traffic, and the repeated activation of market-wide circuit breakers. And as Kevin mentioned, the exchanges with us today are all members of the Equity Markets Association. We have the EMA's mission statement slide up there on the webinar for you to see. The EMA was established in 2015 to provide federal policymakers, regulators, and investors with in-depth analysis on important issues that impact the U.S. equity markets. Its founders, Intercontinental Exchange, Inc., which owns the NYSE, and Nasdaq, believe in a fair and transparent marketplace which incentivizes capital formation and ensures a robust secondary market for trading securities. Cboe Global Markets joined the EMA last year in 2019. The EMA was created in response to the void of regular and consistent viewpoints from exchanges on issues that impact the nation's capital markets. Consequently, the founding exchange's intention is for the association to assist policymakers by providing periodic summary and research papers on specific topics impacting investors and issuers and equity market intermediaries, such as proxy governance and corporate and investor disclosures and equity market structure. In addition, EMA works to coordinate industry initiatives and discussions on issues from coordination among markets during natural disasters to cybersecurity threats to financial markets. Now let me introduce our three all-star panelists. Michael Blaugrund is the Chief Operating Officer of the NYSE. Tal Cohen is the Executive Vice President and Head of North American Markets at Nasdaq. And Brian Harkins is the Executive Vice President and Head of Markets at Cboe Global Markets. We thank all of you for joining us this morning on this webinar. So let's get going. We'll kick off our questions and answers. I hope to have an interactive conversation, and I encourage our panelists who are not shy to please jump in if you'd like to respond or add your thoughts. So our first question, I'd like to start with Tal Cohen. Tal, what do the U.S. markets look like today as compared to the weeks of March 9th and March 16th before the pandemic's impacts really hit?
Thank you, Michael. And I'm just going to extend my appreciation to EMA for today's event and to you and Kevin for leading today's event. So if I went back in time and I thought about the beginning of this health crisis and what markets look like then versus now, we're still at elevated levels of activity. The VIX is still around 28, 29. But if you go back to early March, the beginning of the health crisis, it was really an exogenous shock to the system, both on the demand side and the supply side. And so what you saw early on is markets and investors were trying to get used to all the real-time information that were coming into the markets. And the markets weren't necessarily discerning between those companies that were vulnerable and those that were not. And what we've seen since then is there is a lot of separation between companies that are clearly vulnerable to what's gone on and those that are actually part of the solution. And so when I think about then market performance over that period of time, and just for people to recollect, the VIX that month, for the month of March, was around 60, and generally it's around the teens. On some of the days where we trigger the market-wide circuit breakers that you alluded to, we had up to 1,500 LULDs, which is the single stock circuit breakers. We saw spreads expand 5-6 times normal, and now they're contracting and almost back to what we expect, but still elevated. And depth in the market was about half of what we normally see. So markets were getting used to this information. The performance of the markets in many ways was unprecedented. We had days that the markets were down 9%, followed by 9% up days. And we had not seen that since the 1930s. But let me just take a second and separate that from the functioning of the markets. Throughout the entirety of the crisis, the markets have functioned extremely well during the height of it and as we've continued on. And I think markets have been part of the solution. So unlike 2008 and 2009, where the financial service industry was maybe part of the issue and part of the problem, in this crisis, I think markets have been part of the solution. So it's functioned really well. And it's not just the markets, it's the entire ecosystem. It's the security information processor. It's the transaction reporting facility. It's the brokers. It's the post-trade facilities. We've all been stressed. We've all been taken to the edge, but it's performed well. And that's a function of all the investment that we've made over the last 10 years with regards to resiliency and capacity.
Thank you for that, Tal. Let me follow up with both Brian and Michael. How, in your view, how did the markets and market quality stand up during these initial months of the COVID crisis?
I'll go first. Thanks to Michael, Kevin, EMA for having the event. When you think about the early days of the crisis, it was really a tremendous test for investors and for market infrastructure. And as Tal said, we saw conditions that really were sort of unprecedented since the 1930s. And if you look at the month of March, there were 13 days when the S&P moved more than 4% during the day. In the prior decade, it only happened 10 times. So it's really sort of an unprecedented level of investor uncertainty about the value of assets. What we saw sort of overwhelmingly was that the system was predictable, it was stable, it was resilient, and that extends beyond just the exchange systems, but the broker-dealer community, institutional investor community, and having a well-understood, well-functioning, and high-capacity national market system was really crucial to restoring the confidence of the investing public. So while some of the metrics degraded during the period, I think the confidence in the system remained high, and it was absolutely crucial that it did.
Brian.
I would add, yeah, first of all, thank you for having me. I'll echo Michael and Tal's comments. I'll equate it to March was like going fishing in the middle of an intense storm. I don't know how many fishermen are out there, but and sometimes the storm blows in quickly. And so March was about how do we deal with this risk? How do we get through this storm? How do we survive? And you know, when that we saw the form of hedging, taking liquidity, recalibrating their risk. March was about really dealing with that storm and getting that boat back to shore safely. I think if we look at it now, volumes are still high, but we also see a lack of directional bets. Yeah, you do, as Tal mentioned, it depends on the industry, depends on the stock. But overall, the directions of the markets, we still see a lot of traders, asset managers, hedge funds on the sidelines, where they just don't have that they just still have a lack of conviction until they see, we're just starting to see the reopening of the American economy. When have the COVID numbers plateaued? We think we're there, but there's always the fear of, a kind of a second wave. Unemployment, when does the unemployment numbers reverberate throughout the industry and affect other? So I think time will tell, but we're seeing still a lack of directional bets. As far as the operational resilience of the markets, echoing what Tal and Michael said, if you go back to that fishing analogy, when you're in the middle of a crisis, in the middle of that storm, can you count on the boat? Can you count on your instruments to work properly to get you through it? And I got to just say, as an exchange executive, it's this is like a decade or more of behind the scenes work on operational resiliency, testing systems. We hit multiple market-wide circuit breakers where we halted the market, and that went about flawlessly, really through the work of systems testing. We do this regularly, planning for that crisis. And in short, really the investors could count on the fact that their boat is going to work and get them through the storm.
It's a great analogy. Kevin, over to you.
Terrific. Thanks, Mike. And we'll have Brian take this question. Why do we see volume gravitate to the lit exchanges when markets become volatile?
Yeah, I think it's a lot of it has to do with, in a time of crisis, again, when immediacy is more important, is the most important thing when you're trying to hedge quickly. What you see is what you get, and that flight to the lit markets becomes especially important. And when the risk profile of your trade increases, taking your time to kind of try to peck around and source and ping liquidity in the dark, there's an opportunity cost, and it increases the risk profile of your trade. Whereas in the lit markets, people are not trying to save on every little extra cent, or maybe perhaps they're de-emphasizing fees and commissions. They really need immediacy to hedge their risk, and they certainly gravitate towards the lit market.
Thank you. And Michael, what about some of the SEC's initiatives in the aftermath of the flash crash, such as the limit up, limit down rule, Reg SCI? How have those initiatives, and now more than initiatives, how have those rules and programs helped to play in market preparedness?
Well, it certainly was one of the contributing factors to the level of resiliency and success we saw in late February, early March, and into April. Having a clear understanding of the volatility controls and the limit up, limit down program that applies to single stocks, and the broader market-wide circuit breaker program, those well understood initiatives prevent the need for some sort of improvisation while we're in the middle of a crisis. And so it's important when you're in the middle of a time of stress that people understand the rules of engagement. And so having, a sort of consistent, clear method by which the market would dampen volatility really served us all well. Reg SCI speaks to system resiliency, and it's a significant, regulatory program that all of the exchanges and some of the larger dark pools have to abide by, which establishes very strict controls around system changes, testing regimes, and other programs. And while I think the exchanges have long had, sort of exemplary testing and have been held to a very high standard, the fact that it's now institutionalized with this regulation, the fact that it can be extended beyond just the exchanges, has really made it a point of emphasis for the industry. Perhaps one of the lessons learned might be that, SCI could be extended even more broadly to ensure that that level of resiliency is broadened across the industry.
And Tal, oh, go ahead, please.
Yeah, if I could just jump on what Michael said, because I thought he raised a number of good points, is it did not happen by accident. It is applying the lessons that we've learned as an industry dating back to 2001. And really after Reg MS over the last decade, we spent as an industry a lot of time investing in resiliency, dealing with single point of failures, putting new market guardrails in place, harmonizing the way that markets work during times of stress is really important, having that clarity, the level of industry testing that we now have and that we conduct. And then finally, making sure that backup procedures, like what happens when something fails, is much more well understood today than it was 5-10 years ago. So all of these lessons have been applied after each of the different events and crises that we've gone through, whether it's Hurricane Sandy or August 24th of 2015 or the flash crash or 2008. So I think it's really important to understand that 10-15 years, we really optimized around the current market structure to try to protect investors and fortify the resiliency of our markets.
Thank you, Tal. Mike, back to you.
Michael, how important is it to make sure that exchanges and markets stay open through crises like these?
It's a very good question, and it's one that I wouldn't have anticipated needing to answer at the beginning of the year, but it became a very relevant question in the middle of March. I think there were a number of people who were very well-intentioned, who felt like closing the markets or declaring some sort of market holiday would bring calm to investors. And while that's well-intentioned, I think it's actually flawed. I think it's very important that investors have continuous access to their savings, particularly at a moment when they might need to dip into those savings, such as the pandemic. And so, any suggestion that the markets would not remain continuously open, I would fear could actually create a rush for the exit. We've had the opportunity to speak with former Treasury Secretary Nicholas Brady, who actually was sort of the grandfather, the architect of the market-wide circuit breaker after October of 1987. And the purpose of instituting a program like the market-wide circuit breaker was to establish a priori what would happen in the case of a rapid market decline, to try to take off the table the risk that the markets would be closed. And I think what we saw in March was that, despite this being the first time in sort of the modern era that the market-wide circuit breakers have been invoked, they did their job really well. Investors knew that there would be certain levels at which the market would pause, but that they didn't need to try to sell right before those levels because the market would resume promptly. And I think in each case, we saw the market respond favorably after the market-wide circuit breaker in a very orderly fashion. So, we were certainly very pleased to hear, from all of the sort of sober voices, across the industry and from the administration, that maintaining the markets as a continuous function throughout the depths of the crisis was a priority.
Brian, another idea we heard was changing hours of trading or imposing short sale restrictions. Would those have been a good idea during the crisis?
Well, I think it's similar. Your answer is no. Similar thought process to Michael, that traders, investors, and especially market professionals count on certainty and the rules of the land when it comes down to navigating the crisis, navigating intense volatility. And not to mention that, all of our systems are hard-coded to specific rules. Not that you cannot change those rules, you can change those rules, but you don't change those rules on a whim or in a hasty manner. You have to have the reason why market-wide circuit breakers went off flawlessly. The reason why limit up, limit down performed the way they did is through thorough testing over months and years. Changing the rules mid-flight not only add additional risk to market participants, but we open ourselves up to technical failures, and even just changing the hours. It sounds simple where you just change the clock, but how all of our systems perform and all the nightly maintenance cycles are keyed on specific times and dates. With respect to short selling, it's similar to, you have to be able to allow market participants, and especially market professionals, to be able to hedge and provide quality liquidity so that the average investor can dip into their savings and get the liquidity that they need. Short sale is an essential part of day-to-day trading.
So simple ideas, but maybe not so simple in practice. Kevin,
And jump in on both those. So
go ahead.
Sure.
Yeah, I want to go back to what Michael answered, and then maybe also build off of Brian. In terms of just the way we view the markets being open, once again, every time a government official spoke to us or anybody at the SEC spoke to us, we said we want to be part of the solution. We want to support investor confidence. It's important that we stay open for those reasons. Michael mentioned investors. We saw a lot of retail investors come into the market. To the extent that the markets are not open, people have liquidity needs, investors have liquidity needs. It's dangerous to keep the markets closed while people have liquidity needs. Issuers, in particular healthcare companies that were still coming into markets, if they had R&D associated with a healthcare issue or potentially COVID-19, it was important that we kept the markets open so they could access capital for those reasons. And then finally, when we looked at markets that did close, and it's not a perfect corollary, we looked at the Philippines, they closed for 3 days. The market was down 26% when they opened up. And that's because it has an impact on the consciousness of the market and risk taking. So how do you warehouse risk? How do you think about risk if you think the markets are going to be shut down for 3 days? And I think that plays into how the markets operate. And then jumping on Brian's question, which is, around the hours and short sell, it's really important to separate those two. One is we did consider shortening the hours, but as Brian said, you introduce change during a time of crisis. And by the way, the marginal benefit that we saw was on the post-trade side for institutional settlement. So we reached out to DTCC, we reached out to institutions and brokers and tried to understand what the real benefit. And we weighed that against the additional velocity and volatility that would be compressed into a shorter trading day. And we decided that it wasn't worth that marginal benefit, especially given that it was a change. But then when you think about the short sale rule, I think it's really important to understand we do have a short sale rule. We do have Rule 201. And there's a short sale restriction, and it's fairly onerous in that it applies not only to the existing trading day, but the next trading day. And so there was a lot of discussion about short sale banning and whether that was appropriate. And all you need to do is go back to the data from 2008 and see how those companies performed, or look at Europe for those markets more recently that applied a short sale ban. And you'll understand that it has an impact on liquidity. It hollows out depth. And the reason for that is liquidity providers suffer. They can't make markets in the same way. So we looked at that and we advocated strongly against either short sale ban or shortening the trading day, and tried to stress to everybody we want to be part of the solution.
Thanks, Tal. Switching gears just a little bit into some market structure. As the pandemic spread throughout the US, the SEC was one of the first, if not the first, agencies to have its Washington, D.C. staff work remotely. And most agencies in the federal government suspended their regulatory agendas and moved to provide relief to market participants in the industries that they oversee. But now the SEC and other agencies have returned to regularly scheduled programming and are starting to pick up their pre-COVID-19 rulemaking agenda. So Brian, the SEC has proposed some transformational market structure changes in the past 5 or 6 months. Are those a good idea?
I think, going back to how we've performed as an industry and, the exchanges being really the bedrock foundation of all the infrastructure and plumbing that allowed a near flawless experience for investors in a time of crisis. So it kind of goes back to the answering the question, are investors getting a good experience trading on our markets? Spreads are narrow. Yes, they've come up in a time of volatility, of course. Retail trading is free. Competition is vibrant. Systems are resilient. The operational uptime has never been better. The infrastructure that we've been talking about, whether it's securities information processor, all is working. So really, are we serving the end investor well? And I think the answer is quite simply yes. If you really, now let's put on our imagination caps. If you think about some of the things that the SEC is proposing, whether it's competing SIPs, competing consolidators. So picture now we have one centralized security information processor that's been working very, very well, especially in a time of crisis. Now, let's say that there's now 10 of them. Competition always sometimes can be viewed as a good thing, but does that further and increase the investor experience? What happens if we have multiple failures of various SIPs? Does that create more points of failure rather than today? When you think about things that way, the SEC has also proposed a pretty invasive transaction fee pilot, including partly to ban rebates. In March and April has been a very difficult time to trade. Spreads widened to the point where they're even higher than the financial crisis of 08 in certain days. Picture a ban on rebates in that environment where the only thing that really can help offset standing in the market and offsetting that risk is a financial reward for market makers that are trying to navigate that storm that we're talking about. So it really kind of comes back to full circle is the question is, what are we trying to accomplish? The markets are working well. The investor experience it's never been better. And are we going to operate on a patient that is not sick?
Thank you, Brian. And to Michael and Tal, another topic that has been part of the discussion for, oh gosh, more than 20 years is market data. And what do you think, to both of you, the public or the industry misunderstands about what the SEC is proposing in its market data infrastructure rulemaking?
Well, I think that one sort of common assumption might be that the market data infrastructure proposals and the governance proposals, or I guess governance order that have recently been put in place, that they won't be impactful to them, right? Perhaps it'll reduce their fees, perhaps it'll adjust something in the background, but it won't have a major impact on their business. In fact, these are actually very far-reaching proposals that not only upend the market data infrastructure that's been performing so well, as Brian described, but also, sort of to keep with the nautical motif, throws overboard some of the long-standing foundational relationships between displayed quotes, protected status, round lots, and some of the sort of assumptions that system designers and technologists may have made in code that's throughout their technology stack. There are other ways to potentially reform market data. I think each of our exchanges have proposed more tactical, limited, surgical changes that could improve what is already, kind of a world-class and sort of enviable market data infrastructure. But what has been proposed, as others have described, is really Reg NMS 2.0. It's really a seismic shift in how the public markets operate. And so I don't know that people really anticipate the degree to which their businesses are going to have to change as well if this proposal moves forward.
Tal?
Yeah, and I think it's helpful to parse the two proposals. We had one in January, and then they followed up with another on Valentine's Day. And so the one from January, a bit shorter and more focused around a single consolidated processor plan, talked about governance, and I think referred to a lot of the things that us and others have proposed previously. So we can get behind addressing concerns around resiliency and geographic latency and making sure that governance is expanded. And so we understood the impetus for the January proposal, although we still need to review it, and we have some questions around governance and how it would work, and are they trading one set of conflicts for another set of conflicts. But we can at least work with that and try to understand where the SEC is coming from. With regards to the February proposal, as Brian and Michael alluded to, it was about market data, but much more than that. And so when we looked at that, we asked ourselves the following questions. One, is now the right time? And the reason we asked that is twofold. One, of course, because of what we're all dealing with COVID-19 and the health crisis. But maybe more importantly is because of how the markets function during the current crisis. We just talked about it functioning well. And so if you're going to judge market structure and evaluate how it works, you tend to look at periods of stress and say, did it hold up? Did it function well? Did it embrace investor confidence? And I think to a large degree it did. And so then we took a step back and asked ourselves, are there parts of market structure that we would want to modernize, of the framework regarding market structure? And the answer is yes. And there are more acute problems with regards to the rules, like the one-size-fits-all nature of some of the rules that we would like to address. And so we think there are areas in which we can be proactive and more exacting in addressing those concerns. But when we read the SEC's February proposal, which was 600 pages long and had 300 questions, what we saw was something that was very broad, comprehensive, that had the potential to introduce risk and complexity. And you need to weigh that against choice. And so I think the underpinning is, do we want that choice? Have we weighed it appropriately? And so when we think about risk, we think about the 10 years of investment we've all made, the industry holistically, around fortifying our markets. Everything I spoke about before, the resiliency, dealing with single points of failure, harmonization between market infrastructure providers, the new market guardrails, industry testing, all of that. Let's make sure we do not undo any of those benefits. And then with regards to complexity, what we saw was three things, really. One was the fragmentation of the NBBO. And so would that lead to locked markets, cross markets, trade throughs? We need to understand what the fragmentation of the NBBO will do to the market. The second was we saw them complicating price discovery, potentially, because now we have a regime of protected orders, non-protected orders, protected odd lots, non-protected odd lots, protected round lots, non-protected round lots. And so we thought about price discovery in that framework. And then finally, it's just the decentralization of the distribution of market data. And when we thought about that in competitive SIPs, we asked ourselves, does that then give rise to an arms race? And so those are the decisions and the calculus by which I think us in the industry need to judge the proposal. We'd like to see us in the industry take a more exacting incremental approach. There are a lot of alternatives that have been proposed by us and others over the last 6 months. I'd love to see them get some airtime and evaluate against some of the proposals being put forth. And I think that will make for a constructive conversation, but that will take us some time to get there.
Tal, let's stay with market structure here for a second. Take out your crystal ball, or if we're gonna stay with our nautical imagery, look over the horizon, and what proposals do you see possibly coming out of the experience of March and since then? You're touching on this a little bit, but what do you see that could possibly come out of this?
I'm of two minds when you ask that question. One, if I had my druthers, what would I like and what would like? And then second, more practically, what would probably happen? But if we had our druthers, this is where I would like us to focus. And I think we are to some extent. We're looking, for the first time ever, we have data on market-wide circuit breakers. Let's look at the data. It's no longer theoretical. Let's think about how to optimize how market-wide circuit breakers operated. For instance, do we need better futures market? We have to ask ourselves the question about, do we need a market-wide circuit breaker at 9:30 and a half a second? How do we calculate that? Are the levels right? All of those questions, we finally have data. Let's make use of that data while the iron is hot and try to make sure that something that's supposed to protect investors and protect the market, we're taking the opportunity to do our best on that. The second, if I had my druthers, would be the relationship between markets is greater than ever. They're interconnected, and there's a ripple effect between markets. And you saw that with some of the dislocations between, say, fixed income ETFs and the underlying fixed income markets. And so we saw products, the ETFs trading at premiums and discounts, which gave rise to questions around, well, is it the underlying markets or is it the products that are on the equity markets? And why is that? And so more broadly speaking, I'd love for us to think about the fixed income markets. How did they perform during times of duress? How did liquidity, transparency hold up? And did the Fed have to intervene for different reasons, of course? Why did the Fed have to intervene? How can we think about market structure? What are the knock-on impacts that the fixed income markets have on the rest of our markets, especially as we have this interrelationship, if you will, between these markets ever expanding? So those are things that I think we could look at and we would benefit from. Going back to what I think we will look at or more practically try to assess is some of the proposals that all of us have put out, not just the exchanges, but the industry at large, I think intelligent tick sizes, as we think about the odd lot problem, which is really a function of high price stocks and a lack of stock splits. And we all see it, we all see the odd lot problem. We understand that. We understand that 100 shares of Amazon is not 100 shares of GE. One's a block trade and one doesn't even look like a retail trade. And so we understand that, we can address that. There are alternatives out there. I think there's I think motivation on both sides to look at that. And I think the SEC would benefit by considering some of those alternatives. So I think those are the types of things. I think the SIP, there's progress we can make on the SIP, and I think Michael alluded to that as well. We have proposals out there around governance, about consolidating the plan, about ensuring there's resiliency, and we address the single point of failure. And so those are the things where I think more practically we should pay attention to. And once again, higher level, let's make sure if we ever get into a crisis like this, which by the way is now happening every 8 or 9 years, we've taken out the time and really invested the time to understand how we're protecting investors, both institutional and retail.
So Michael, we're talking about these SEC rulemakings. Are they well understood? What do you think that the public or the industry maybe doesn't understand about some of these SEC proposals that you think may be causing problems?
Well, I think as a starting point, the February 14th proposal that we've been discussing, that has been proposed during a time of considerable stress across, well, the globe, but within the industry, between trading floors being closed, between people working from home, the idea that a 600-page proposal would be digested and evaluated and commented upon in 60 days is fairly absurd. And so I worry that perhaps the comment period for some of these proposals is somewhat illusory, because there's simply not the capacity for people to give these important issues the attention they deserve. The SEC is doing important work. They've been extremely helpful and thoughtful and solution oriented with respect to coronavirus related activities and helping ensure stability of the market, helping each of us, close and eventually reopen our trading floors. So, they're doing good work when they focus on investor protection and when they focus on, sort of the practical, matters of running the markets smoothly. It's really important that when we talk about changing incentives for market participants or changing the underlying mechanics of how things will work, such as allowing people to evaluate their 606 reporting off of a data feed that they're producing, in effect, sort of grading their own homework. There are consequences to some of these proposals that are not immediately obvious, and so I think it's really crucial that they first do no harm, and as a starting point, allowing the industry more time to evaluate some of these complicated proposals would be very wise.
Thanks, Michael. So again, staying with market structure and all of the topics that we've been touching on, we've had over the last few years a number of market structure related proposals. In addition to what we're talking about, we have the CAT, we have the ETF proposals, we've had other responses to the flash crash. We've talked about the access fee pilot, we've talked about the market data proposals and NMS 2.0. But if we take a step back and look at those holistically, are they all working well together? Brian, do you have any thoughts on that?
Well, I think, some of them are a little too early to tell. For example, CAT, we're not quite there yet. And I think, based on what we've learned, whether it's some of the things that we've already implemented, whether it's limit up, limit down, Reg SCI, it takes sometimes years to evaluate the effectiveness. And sometimes it takes a crisis to evaluate the effectiveness. I think what we've clearly discussed today, whether it's limit up, limit down, market-wide circuit breakers, Reg SCI, some of the things that were really born over the last 10 years have really proved themselves out as being quite effective. Some of the things around the access fee pilot, and some of the the SIP proposals, I very much fear that we are perhaps maybe moving too fast, in the sense that there needs to be broader industry debate and dialogue on these topics, which could, to Michael's point earlier, it's not just about, hey, it does not affect the end investor. These are just small tweaks. No, these are potentially transformative things that can really disrupt quite a good thing that we've built. So, from Cboe's perspective, we're definitely want to have the dialogue around improved SIP and governance, and making sure that we can continue to move forward on always trying to seek perfection. But that said, we do need to take a do no harm approach, and anything that's going to be drastically changing infrastructure as well as potentially impacting liquidity really needs to be thoroughly debated.
Thank you. And Michael was alluding to the February 14th proposal and the length of the comment period. And Tal, so far, the NMS 2.0 proposal has not really generated a whole number, not a large number of comments relative to similar proposals that have been put forth in the past. What do you see about? What are your thoughts on the lack of comments on the NMS 2.0 proposal, Tal?
Allow me to offer a few data points on that. So, and the timeline as well. So we had the January proposal that was effectively approved beginning of May, and then we had about 3 weeks to respond to the February proposal we're talking about now. And there's a lot of interaction between the two. And so while trying to digest the approval order, we were also trying to come up with comments that were informed and connected to two proposals. So I think there was just a lot of work between those because the dates were tight. But think about this. The corollary for us in terms of the size of the proposal, the last time we saw something like that was Reg NMS 1.0 in 2004 and 5. And there were 700 comments, 700 letters. This time around, there were 44. And so that's just about 5% of what we saw. And this is during a period where issuers and institutional investors are much more active with their voice around market structure. So you can see less than 5%. Parse that even further, 10 of the letters were effectively asking for a delay or for more time. So now you have 34 letters versus 700. And then when we look through who submitted the letters, it was clear that it was coming from trade associations, where on many other topics, we saw individual firms comment. This time around, the letters were much shorter, and it was clear to us that people had to lean on trade associations because they simply didn't have the time to put into this proposal and evaluating the way it should be evaluated. So we would say that dialogue is really important. Debate is really important around things that are comprehensive and broad. And if you look at the amount of responses that the SEC has garnered to date, it should be of a concern to them and to us. We need to give the industry more time. We need to make sure we don't ignore certain parts of the market, whether it's smaller broker-dealers, issuers, institutional investors. We want to hear everybody's voice. And I just think that more time will benefit us, in particular if we go and make decisions around complex issues. And I would just note one last thing. In the 34 or so letters, it was clear that there were some parts of the proposal where there was broad agreement, but there were some parts of the proposal that warranted much more debate around OPR and odd lots and the complication that that would bring. So it's clear that people want more debate. It's clear that not a lot of people had time to weigh in, and that we would eventually benefit, all of us would benefit by an extension of time.
And as we look at, thank you, and as we look at the 2.0 proposal, do you think, and Brian and Tal, please take this off, and Michael, jump in. Do we want to get an understanding? Does the public really understand that part of the 2.0 proposal would affect the national best bidder offer, the NBBO, and replace it with competing potentially NBBOs? And what does that mean to investors? What does that mean to quality? What does that mean to spreads? So Brian or Tal, start off.
You know, my opinion is I don't think the end investor cares to know the details, would be confused by the details, and I don't think this is about the end investor. I think that, you know, going back to the SEC's market data roundtables, I think it was 2 falls ago, seemed like forever ago. You know, a lot of the dialogue was around and debate amongst industry professionals. And so industry professionals want to make sure that there's good governance of the SIP, that there's vibrant competition, that costs are reasonable. But at the end of the day, you know, when it goes back to the question we've been saying over and over again on this panel is, are we serving the end investor well? Is the end investor having a good experience with today's market infrastructure? And the answer is an unequivocal yes. So this is oftentimes this SIP and the market data debate is around industry professionals, and is the current setup optimal for competition amongst industry professionals? And I think that's really what the debate is about.
Al?
So we looked at it from the perspective of not just the February Valentine's proposal, but as somebody alluded to before, the full collection of proposals. And we looked at it through the lens of, what does it mean for market quality? What does it mean for investor confidence? And does it address some of the acute problems that we have in our markets today? And I'll give you one example. The SEC, to their credit, had gotten behind thinly traded securities. They're liquid, they have some issues, they may not have benefited from Reg NMS 1.0 in the same way that very liquid securities have. And so if you put the latest proposal against thinly traded and try to understand what it means for that part of the market, the synopsis is that it doesn't necessarily help it. And so we look at it and say, we've all agreed that we want to do something around thinly traded. Not sure how Reg NMS 2.0 addresses that. In some ways, it complicates that. And so I think we need to have a North Star around market quality, investor confidence, look at the collection of proposals and ask ourselves, to Brian's point, are we addressing the key concerns in the market? And we want to listen to our customers, all of our customers, the broker dealers, the buy side, retail, everybody who's putting money to work in the markets, try to understand concerns, try to make sure we address those concerns reasonably and fairly, and make sure it's not a left pocket, right pocket matter, but rather a matter that we solve. So now in 5 years from now, we're not having the same debate. And we're not looking down the lens of capital formation and saying, hey, we've kind of helped parts of the market, but now capital formation itself is suffering. And so those are the things that we think about, and we love to engage the SEC and the industry on, because I think it's the collection of those proposals that would otherwise concern us.
I would just add that I think the level of engagement historically, sort of like earnest intellectual engagement with the exchanges on these topics was stronger, right? It seems like now, the back and forth with Washington is a little bit more unidirectional. And I think that's a real loss, because there's tremendous experience, and as Tal described, we're very interested in serving a broad range of stakeholders. And so allowing for more time on some of these matters, and really earnestly engaging in a discussion to try to find solutions that may require compromise, is something that I think would benefit all of the stakeholders involved.
Thanks, Michael. Mike, back to you.
Thanks, Kevin. Michael, let me stay with you for a moment. It's an interesting comment you just made, and I'll invite you and Tal and Brian to try to get into the heads of folks at the SEC for a moment. Why do you think the SEC is so focused on actions to change the exchanges, but maybe not so much on other asset classes like fixed income, or as we emerge from a global pandemic? Why hasn't the SEC focused on changes that help with capital formation, like jobs, or incentivize lit liquidity, which has recently come under so much pressure?
It can feel as if the actions are really focused around putting greater constraints and more overhead and more challenge in front of the displayed public markets sometimes. Of course, that's not always true. There's other important work they're doing around investor protection and things like the ETF rule, I think, are viewed broadly as positive developments. But when you look at the sort of collection of market data infrastructure and transaction fee pilot and some of the sort of frictions that are being introduced around the consolidated audit trail, it is easy to get discouraged. I think in part, SROs play a really crucial, unique role in the capital markets, and we have the ability to move nimbly and to execute policy objectives. So I think that's part of why we're conscripted sometimes into these matters. But many of these would better be served through public rulemakings. It'd be better served with a sort of significant industry debate and with cost-benefit analyses that are intellectually honest. Those are the standards that the government agencies should be held to, and where you've seen real disagreements between the exchanges and the SEC, it often comes down not just to policy, but to process. And I think it's important that the process be adhered to, and we're trying to ensure that that's the case.
Brian?
Yeah, look, I don't have a ton to add there. It kind of comes down to the Exchange Act and really sort of the legal relationship that the exchanges have with the SEC, where it's frankly, it's probably an easier tool for the SEC to affect market change through not only responding to exchange rule filings, but also through affecting change through the rulemaking process itself. And doing broader NMS plans, kind of as we're talking about here, it requires a lot of dialogue, a lot of debate, and it's a lot of work, probably multi-year process to change the industry, whereas things that the SEC put forth and effectively force the exchanges to do might be a little easier way, a little easier path to making some change, which we find a bit frustrating.
I might just add that all of us have good constructive working relationships with the SEC. Not because we have to, because it's over years we've developed relationships with the SEC and the industry on a number of these matters. So even where we disagree and disagree strongly, we're always going to keep an open line of communication. We're always going to want to engage and have dialogue there. And for us, if I just took a step back and contextualize it, when Chairman Clayton came in, we were really encouraged by the mandate that he set out around capital formation. And we were completely aligned around looking at private markets and public markets and thinking about how to make public markets more attractive. And they've done good work there, in particular around proxy proposals and other areas of the market. So we commend the SEC and work closely with them on a number of topics. And we just talked about the ETF rule and the ETF proposal, and I think that was extremely helpful. But it's certain proposals taken, once again, as a collective that we've looked at over the last year and a half, and we asked the following questions. Is it data-driven? Can we understand the impact on investor confidence? Can we understand the impact on market quality? Can we understand the impact on all constituents, issuers, investors, large broker-dealers, smaller broker-dealers, the entire ecosystem? And then finally, we look at against the backdrop of what we've been able to, as an industry, accomplish over the last 10 years. And this goes back to the lessons learned in times of stress and in times of crisis that we've implemented. And we've invested in a lot of ways around infrastructure, resiliency, capacity, to make sure that the markets hold up. So let's just make sure that's the backdrop that we weigh these new investments and new proposals against.
Okay, so one last question. We're coming toward the end of our time together. I'll invite each of you, I'll start with Brian, and I'll invite each of you to take maybe 30 seconds, which is never fair, right? But as we wrap up, conditions in the current market are still elevated, and certainly as compared to 2019. What should we focus on now moving forward as some lessons learned? Brian, why don't you start us off?
Well, I think it comes down to what has worked well and what has not. I think with some of the potentially the past episodes of volatility, whether it's the vol event, I think it was of 2018, February 2018, or was it the flash crash? Was it the financial crisis? Something broke down, whether it was a product, something structurally wrong with a product, whether it was something infrastructure related, or maybe it was some sort of investor protection or transparency or lack of education or the lack of a warning label. In this particular crisis, everything has worked operationally. So really trying to keep it to 30 seconds is the thought of the day, but perhaps there are things like, what have we learned, to Tal's point around market-wide circuit breakers? Are there rooms for improvement on some of the things that we probably didn't do perfectly? Spreads definitely widened, that's for sure. But operationally, resiliency-wise, everything worked near flawlessly. I think we can just focus on some of the things that we haven't tested in a while. What can we learn through the recent crisis?
Mike, you want to take a crack at that?
I think I'll go back to my earlier comment, which is to the extent Reg SCI was a catalyst for improvement in the displayed markets, let's try to find an analog to apply to dark pools. Let's try to find a way to ensure that investors are can be confident that they have strong, stable systems, not just when they deal with major markets like us, but any place that their orders may be routed.
Tal, take us home.
There are many areas, and we can all agree, there is lots of opportunity ahead of us to improve the markets that we have today. We would just ask that we focus on those areas where we can jointly agree with the industry and the SEC how we move forward, and make sure that we evaluate these proposals on a data-driven basis and not break anything along the way in terms of investor protection and the quality of markets. And let's also remember, we don't live in a bubble. We do compete against other markets for listings, for liquidity. And so when I think about our opportunity coming out of this crisis, it's to shine once again, show the world that the US equity markets are the most liquid, the most transparent, the best in the world. And that's what we need to continue to focus on.
Well, an hour can go by very quickly, especially when you're talking about big topics. So these have been important topics. We very much appreciate each of our panelists, Tal and Mike and Brian, for joining us today. Thank you to your organizations. And I want to thank my co-host and colleague, Kevin Edgar. Kevin, thanks for your work today and preparing for this very informative webinar. And we invite you, if you have further questions, please reach out to the communications organizations for each of our three panelists' companies. And we thank you very much from all of us here at BakeHostetler and the Equity Markets Association. Thanks for joining us here today. We'll see you next time.
Thanks.
Thanks, Mike.
All right, thank you.